For more on this, let's speak to Christopher Tahir, who's Senior Market Strategist at Exness and joins us live from Kuala Lumpur. Welcome back to the programme, Christopher. Now, with President Trump keeping the option of a massive escalation open and demanding compensation from Iran, how much geopolitical risk premium is currently priced into oil?
Hi, first of all, thank you for having me. Yes, we have seen that currently both parties did not have any agreement in terms of meeting up to discuss the further peace talk. So in this case, we see that both, the U.S. side is trying to get more compensation, and on the Iran side, they ask for more requirements to be fulfilled by the U.S. Counterpart. So in this case, we see that the escalation of this conflict is still ongoing, and at the same time we also see that insurers are trying to keep the premium at elevated price. So in this case, we see that we can see that the oil prices will have more geopolitical risk premium in the near future.
Meanwhile, Nvidia is partnering with financial giants to raise $500 billion. Will this debt-driven financing model accelerate the AI boom or risk leaving data center operators dangerously overleveraged?
In this case, we can see in 2 points of view. The first point of view is we can see from the technology itself. The main question is with these funds that they are going to purchase these hardwares, we know that these hardwares can get obsolete very, very soon. And with the current development that is getting faster, the question is who will bear the cost of this depreciation of these assets? That's the first thing. The second thing is whether these companies actually have enough funds or have enough leverage to fund this scaling. With the current expansion on hyperscalers, we see that they get their balance sheet become more and more thinner from time to time, which can actually drag them into this that scheme or this kind of new funding scheme. And lastly, that is also very important is we need to know whether these companies can actually recoup their investment, because we know that many of these AI companies have not actually made any profit. So in this case, they are just spending their money without getting any return yet as of now.
So do the numbers suggest that there is actual demand for this infrastructure?
The demand is there, but the problem is that revenue cannot cover this cost. That is the key problem that they need to solve to be able to ensure that this kind of business model is sustainable in the long run.
And looking at gold prices, we've seen it surge towards $4,400 an ounce ahead of the US inflation report. Are investors primarily seeking a safe haven from escalating Middle East tensions, or are they defensively pricing in a hawkish inflation surprise that could influence the Federal Reserve?
In this case, I tend to see it as hawkish inflation point of view, because we don't see that investors are actually pricing in this geopolitical risk, because what is happening here is in the current geopolitical tension, we see that it is actually driving energy prices higher, which actually cause another problem. In this case, elevated inflation. So in this case, investors are actually looking at this hawkish inflation condition, and at the same time, with the recent jobs data that is weaker, it seems that investor is trying to guess or speculate that the upcoming inflation data can be weaker because of the recent decline of energy prices. But the main question will be how long or how sustainable that this lower inflation will be in the long run.
Christopher Tahir in Kuala Lumpur, thank you very much for your analysis.
It's my pleasure. Thank you.